This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney, where the market has just opened. The top stories this hour. Asian stocks are set to extend gains after Wall Street traders welcome Donald Trump's pick of Scott Bessent for Treasury Secretary. Treasuries are rallying across the curve. Oil and gold prices sinking as Israel says it's moving closer to a potential ceasefire deal with Hezbollah. And Minneapolis Fed President Neil Kashkari tells us a quarter-point rate cut next month is a reasonable debate, with inflation gently trending down.
And really, you said, and Heidi, was about the Treasury's move, the dollar move as well, right? That nomination by Donald Trump of Scott Bessent for Treasury Secretary really moving markets, and even swaps pricing in less easing from the Fed in 2025. We're talking about 70 basis points of rate cuts by the end of next year. Is that expectation that perhaps this new Treasury Secretary will be able to temper Donald Trump's policy proposals? Actually, take a listen to what Scott Bessent himself has told us on Bloomberg TV when it comes to a little bit of his thinking on economic policy.
He has a deep understanding of financial markets as opposed to most politicians. So he wants to be involved in the conversation. He has very well-formed opinions. He has a lot of private sector friends. All taxes are passed on to consumers. And I think what's interesting about taxes is they aren't necessarily inflationary. They're a one-time administrative price adjustment. Tariffs cause a stronger dollar. So a weaker dollar with tariffs is it's an economic abnormality. Jay Powell's reappointment was the latest this century for a Fed chair, latest this century. And I think that is what stoked or certainly accelerated the inflation.
And Shery, at the same time we're watching for these geopolitical developments have so sort of heavily dominated trading when it comes to commodities prices, right? In particular, part of the surge that we've seen in gold and some of the worries over oil as well. We are hearing that Israel and Hezbollah are inching closer to a truce, and we are hearing that we're getting pretty close to that ceasefire agreement, and an Israeli official saying that a security cabinet is set to convene on Tuesday. It does still remain unclear if Hezbollah will agree to the proposals from the Israeli side, but potentially we are days away from that ceasefire agreement with Lebanon's Hezbollah. It's been a new round of shuttle diplomacy by a senior envoy for the outgoing Biden administration to try and get this across the finishing line, of course, before January. The Israeli ambassador to the US saying that we are close to a deal. So we'll be waiting to see the outcome of that security cabinet meeting on Tuesday and potentially a vote on whether that truce is accepted. In the meantime, you are seeing that drop in oil. Brent crude down by close to 3% at this point. It is light pre-holiday tradings, but a lot of that has to do with the diminishing sort of risk landscape across the Middle East as a result of this potential ceasefire agreement that would, of course, reduce the likelihood of US sanctions on Iranian crude. We're also watching the impact when it comes to gold. That took a tumble. We know that gold has really run up significantly, but these decreasing geopolitical tensions reducing, obviously, that haven demand. Shery.
We'll be watching those commodity stocks in Asia trading. Of course, the ASX 200 coming online in that staggered open already. Not a lot happening at the moment, but when it comes to Aussie bonds, we are seeing them up following Treasuries higher. Yields across the board in Asia have been under pressure this week. Take a look at how Nikkei futures are also setting up 0.2% as the Japanese yen is strengthening a little bit, but still around that 153 level, surpassing that 154 level right there. We are waiting for PPI numbers, the services numbers out of Japan this hour, actually. So that's really a sign of a broadening inflation trend that we'll be watching. But it's really all to do with the U.S. dollar, right? Take a look at how U.S. futures are trading at the moment, because we had seen that fall by the most in more than 2 weeks overnight. And this is really paring back some of those gains from 8 weeks of consecutive gains. We had seen U.S. stocks and bonds climbing. The S&P 500, in fact, in the regular session, topping that 6,000 level at one point before paring those gains. But it's a holiday week, U.S. holiday shopping season getting started. We're watching the Treasury rally as well. We're watching crude prices as well. And we also had some Fed speak with the Minneapolis Fed President Neil Kashkari talking about that it's still appropriate to consider another rate cut at the December meeting. And this is what he had to say about that Treasury Secretary nomination of Scott Bessent. Take a listen.
At the Fed, at the end of the day, no matter who is in these various positions, we know what our job is. We have to get inflation all the way back down to our 2% target, and we have to try to keep the labor market strong. And we're committed to doing that, regardless of who's in the executive branch or who's at Treasury.
Let's get some more now. I want to bring in Katrina Dudley, who's a public market senior investment strategist at Franklin Templeton. As Shery sort of hit the nail on the head, we're watching out for so many different potential developments going into 2025, right? Given the magnitude of policy uncertainty and how that could affect the Fed, how would you be positioning for all of the unknowns at this point?
I think there's three main unknowns. First is tariffs. The second is taxes, and the third is the implications of the fiscal deficit that people are talking about, which is somewhat connected to the first two. As we look at tariff policy, there has been a lot of discussion. The fact is, as we've talked about in the past, is that Trump is a quintessential negotiator. So we're balancing whether or not you take him at his word and what he discussed on the campaign trail, and there's some very significant numbers there, or is that just an opening bid and we expect to see him negotiate or impose tariffs that are less than that? So I think that that's the first point. Onto the tax point, obviously there's a discussion about a lowering of the tax rate. And then finally, we need to be thinking about fiscal deficits and how that feeds into yields and people's concerns about where we're at.
There's also the immigration piece there as well, right, which could have significant implications when it comes to the labour market and the price picture as well.
Look, the immigration debate is real. I think that when we look at what the election told us is that the cost of living is important. And obviously, if we are to, if we have or some level of deportation of workers, obviously there is going to be more pressure in terms of wages, and that will feed into higher costs of living. I'm somewhat encouraged by some of the efficiency measures that we're talking about. We're looking at deregulation of industry, which will free up much of, for people from the federal government, for example. So I'm not necessarily sure that we'll see the full impact of that tightness in terms of the deportation. But I do think that the number that we are watching is the implications that any of these measures have for the underlying cost of living, because we really do need to see those rising costs addressed in the United States and I think globally.
I mean, Katrina, we've been talking so much about potential inflation, about tariffs as well. Are markets accurately pricing in this huge Republican sweep? I mean, this is a very bullish setup.
Look, this is the first time that we've had a Republican sweep. I think we haven't, it's about 23% of the time, if we go back to like the 1930s, that you've had this type of setup. Number one, you're right, it is bullish. The second thing, however, is if we look at implementing tariffs, there's a concern that that will have somewhat of a slowing effect on the economy. If you have a look, however, the revenue raised from those potential tariffs is going to be a positive in terms of reducing our deficit. The final element is what are going to be the implications to corporates from these tax cuts. They could be a driver and a stimulus of more investment here in this country as more spending money is freed up for companies. So I think that generally speaking, you're right, that combination of deregulation, and the fact that corporate tax rates will be reduced, I think is very bullish for markets. The question is, do we need to digest some of this bullish news?
Katrina, a whole different setup when it comes to Japanese politics right now, where Prime Minister Ishiba has been weakened after the elections. And yet, in your notes, you seem to be pretty bullish about the situation in Japan, and you find it interesting. Why is that?
I think if you're in the Japanese market and you're investing in Japanese equities, the story here is a long-run story of positive reform in that market. And I think that that is what we're focused on. I look at some of the policies that have been recently introduced, and I think that the one good piece of news is that the Japanese government is responding to those cost of living crisis and the comments and the feedback that they've received. So you're looking at transfers to low-income families, to families with children. But the more important thing is some of the stimulus and the innovation-focused investments that are going on in Japan. I think that that is going to be good, and it's going to position them well in terms of the new areas of technology, particularly in AI demand. And I think that Japan as a source of AI chips and semiconductor chips, from a U.S. perspective, is a very safe source of supply. So I think I'm encouraged. Those are some of the underlying tenets that have happened with recent policy changes, but you combine that with some of the changes that happened a few years ago from a corporate governance perspective in Japan, and we think that there's just so much runway because we look at the ROEs in that market and they are very low compared with global counterparts.
And Katrina, it's not just Japan that's trying to invest in innovation, AI chips, right? I mean, we're seeing so many countries across Asia, not only when it comes to R&D, but trying to really lure those investments into their countries. What geographies do you find interesting right now?
I think at the moment we still tend to find the Japanese market the most attractive way to play that, just because of, I think, some of the infrastructure they have, given their history in this area, that really secures that source of supply. I think that some of the concerns over supply that is coming out of other regions is something that we are worried about. So we're, unfortunately, in this case, we're actually going to reiterate and double down, I suppose, on our Japanese investment into those technology stocks, because we think it is really a good opportunity. It's a way of getting exposure to AI that is not directly through the Magnificent Seven in the US.
Katrina, great to have you with us. Katrina Dudley, Public Markets Senior Investment Strategist at Franklin Templeton. More ahead on the Asia trade. This is Bloomberg. Take a look at what we're watching when it comes to some of the commodity reaction to the potential imminent nature, perhaps, of an Israel-Hezbollah ceasefire. We're seeing oil dropping in particular as we see that move closer to that truce. Some pretty light pre-holiday trading is at play here in terms of the impact on volumes, but certainly that landscape of diminishing risk across the Middle East is really one that would potentially be playing in here and impacting the possibility of those imposition of sanctions on Iranian crude back in January. But let's get the latest, because we're seeing the reaction across gold as well, with that haven demand also starting to fade. And this is really on account of Israel and Lebanon's Hezbollah edging closer to a ceasefire deal. We've seen a new round of shuttle diplomacy by a senior envoy for the outgoing Biden administration. Let's get more from Bloomberg's Michael Heath. And we have seen these efforts kind of, in the last months of Biden's tenure to try and get this over the line. What are we expecting, given that we know that this key meeting and potentially a security vote will happen today?
Yeah, so Israel's Security Cabinet is meeting today and it's expected to vote on it. And it's sort of been suggested that if they approve it, it could be announced by the US and France pretty quickly after that. So we do seem to be fairly close here. And as you mentioned, obviously with Gaza in the past, we've had lots of positive comments that then never amounted to anything. But I think this is different. In the case of Israel, this is really a conflict of diminishing returns. The initial strike, the decapitation of the leadership there, etc. It all happened so quickly and so profoundly. But as they've moved troops in, Hezbollah's been very smart. They've pulled back because they know that they're on the back foot here. They haven't tried to engage too heavily. So Israel hasn't captured many prisoners, and there's a lot of ambushes by Hezbollah. So Israel's actually lost quite a lot of troops, relatively speaking, in this conflict. So they've probably done as much as they can quickly to degrade Hezbollah, and it's only going to be more drawn out and protracted. And Israel's experienced this in the past, so they know what they're dealing with. It also gives, obviously, it's a gesture of goodwill to President Biden, I think, as he leaves, but also it gives President-elect Trump, sort of what he was after in peace, a degree of peace being established as well. It's an interesting point, though, that what they're talking about is a truce for 60 days. The US would help police to ensure that Hezbollah will withdraw behind the Litani River, which is about 30 kilometres from the border. But if you look at that time period of 60 days, that actually covers through to Trump coming back. So there's been some suggestions in Israeli reporting as well that perhaps the Israelis are just waiting to see what Trump says, and they might get back into it if they feel that that's the option. But I think more likely this is probably, as long as the truce holds, that this will probably be done.
But in the meantime, the situation with Gaza, it seems intractable, right? Even as there's all these warnings about, even in the ability to get international aid in at this point.
Yeah, it's a catastrophe. I mean, and you have to say that Hezbollah is much more powerful, much more dangerous in many respects than Hamas ever was or ever has been or ever will be. But there just seems to be no suggestion that this fighting is going to stop, despite the fact that there's probably still half the hostages that were taken are still alive. I mean, it's extraordinary what they would have gone through. But yeah, there's no sign of that, and the suggestion seems to be that because Israel doesn't have a policy of day after, because if the war does conclude, then there will be a commission of inquiry that's anticipated. Prime Minister Netanyahu will have to deal with these court proceedings coming up. So I mean, you don't want to see this too much as politics, but it's just difficult to understand why they wouldn't try and, get to the bottom of it, or, at least some sort of truce and get these hostages back now, considering how things stand.
What role is Lebanon playing in all of this?
Well, I mean, Shery, Lebanon's obviously it's bordering on a failed state, and part of the deal is that its army would come into that area between Israel and Lebanon. But its army often isn't paid, and it's not as well supplied or armed as Hezbollah is. But the aim is to try and improve that and get them in to help the UN forces that are stationed there to sort of bolster their numbers to keep Hezbollah out. Lebanon is the actual state, obviously. Hezbollah is just a very important component within that state. So they do want Lebanon to be more active, but just it's under such a crushing burden of debt. Its civil services, etc., are barely functioning. So it's just hard to know how capable they are of actually achieving that.
Where's Michael Heath there with the latest on that potential Israel-Hezbollah ceasefire? Now, the European Union is proposing to sanction several Chinese firms that it claims helped Russian companies develop attack drones deployed against Ukraine. For more, let's bring in our Chief North Asia correspondent, Stephen Engel. Steve, so what do we know at this point?
Yeah, well, actually, there are two things that are going on simultaneously. Of course, you have the G7 allies, which I'll talk about in just a minute. They're meeting in Italy. There, according to a Bloomberg document that we've seen, it's not a Bloomberg document. Bloomberg has seen the document drafted by the G7. They're, talking about increasing pressure on China for its alleged support of the war in Ukraine, Russia's war in Ukraine. But the EU, in this headline that we got across this morning, essentially also in documents seen by Bloomberg News, is looking at sanctions, the 15th round of sanctions on a number of entities. EU, according to these documents, proposing trade restrictions on some 36 entities involved in helping Moscow get its hands on banned technologies used in weapons found on the battlefield in Ukraine, or those technologies needed to build those weapons. The list includes firms obviously in Russia, but also Serbia, Iran, India, Thailand, the United Arab Emirates, as well as China and Hong Kong, according to these documents. Of course, China has been trying to portray itself as a neutral party here and has repeatedly criticized Western sanctions. This, as it has said, it has not supplied and will not supply lethal aid to either party in the war in Ukraine. That being said, and I have to put this out there, ahead of the Donald Trump second administration coming in late January, perhaps the EU as well as the G7 is shoring up their support for Ukraine as well as cracking down on Russia's ability in one of these documents essentially saying to limit Russia's war machine. That is in the G7 document. So again, it's a bit speculative right now to say these are preemptive moves ahead of a Donald Trump administration. But again, it's clear that Europeans are trying to basically take their own steps in helping Ukraine on the one hand, as well as limiting Russia's ability to continue its war.
G7 allies are also meeting this week. What are we expecting in terms of further support for Ukraine?
Yeah, so when we get that potential communique, they're meeting in Italy Monday and Tuesday, so they'd be wrapping up later today, Tuesday. This is what their document, as I alluded to earlier, said. They are expected to vow, quote unquote, appropriate measures consistent with our legal systems against actors in China and in third countries who are supporting Russia's war machine. Now, again, this comes on the back of what we heard from NATO allies in July. They called China a, quote, decisive enabler of Russia's war against Ukraine. And keep in mind, you know, while I'm talking about both the EU proposed sanctions as well as the G7 early draft that we are getting right now, keep in mind, in July, Bloomberg also reported that Chinese and Russian companies are co-developing those attack drones that I mentioned in the EU sanctions, which are targeted in the EU sanctions. They are co-developing these attack drones similar to the ones developed by Iran that have been found on the Ukrainian battlefield. So again, we don't have these documents. These are not cemented yet. They could still change, but it's interesting in the fact that the EU, particularly these sanctions, that, like I said, the 15th round of sanctions would be targeting a broader swath of countries and entities, including in China, including in Hong Kong, including in Thailand, obviously Russia, Iran, and Syria.
Chief North Asia correspondent Stephen Engel there. More ahead on the Asia trade. This is Bloomberg. Let's get the latest, Shery, on a story that we've been covering very closely, which has been kind of the faltering ambition, this thematic that we've been talking about when it comes to Adani Group. We've been seeing that reaction across Adani Green shares in particular, the reaction across dollar bonds, as we continue to see kind of this reaction play out, right, from these ongoing issues that we've seen. The Total has halted its investment amid the ongoing US probe. We saw Adani Green falling as much as 11% in the Mumbai session. Of course, Gautam Adani was indicted in the US on these allegations of bribery, but Total Energy saying that it won't make any fresh investment in Adani until the consequences of these indictments and other individuals, not just Gautam Adani, have been clarified. So it really kind of adds to concerns about its expansion plans.
And you're seeing already the likes of Kenya, for example, cancelling $2.5 billion worth of airport and power contracts that Adani Group had pitched for. We're seeing repercussions. You mentioned Total not making any fresh investments. But the key remains that this is a group that's really powerful within India, right? So it's been interesting that at least when it comes to Prime Minister Narendra Modi's allies, they've remained silent on these bribery allegations in the U.S. So he might still have very strong political support in India. We'll continue to follow this story, but we'll be back on the Asia trade. This is Bloomberg. Debate over a potential U.S. rate cut in December is ramping up as investors look ahead to the latest reading on Wednesday of the Fed's preferred price gauge. Minneapolis Fed President Neil Kashkari told us what key factors he's watching for as officials prepare for their final policy call of the year.
Right now, we know that inflation is somewhat above our target. It's running at around a 2.5%, 2.6% run rate right now. I have some confidence that it's gently trending down. And right now, the labor market remains strong. The question in my mind, the biggest question is, where is the neutral rate environment? You know, we've had relatively high interest rates relative to the prior 10 years. And the U.S. economy has continued to grow with great resilience, and the labor market has been resilient. And so how do I reconcile the fact that the policy rate has been relatively high and growth has been sustained that suggests to me that perhaps the neutral rate environment is higher than it was in the past, and that perhaps monetary policy is not putting as much downward pressure on the economy as I would have expected. And so this is what I'm trying to understand right now, is how much downward pressure are we putting on the economy, and what is the path for inflation? But right now, knowing what I know today, still considering a 25 basis point cut in December, it's a reasonable debate for us to have.
Why not pause? You talked about how resilient the economy is. You talk about how resilient the labor force is. You talk about how resilient all the factors are. And add to that, we have, this rally in the stock market. Why not just pause?
Well, you're making good points that would argue in favor of not cutting rates. On the other hand, if I look at the underlying components of inflation, goods inflation has fallen all the way back down to pre-pandemic levels. Services inflation is trending down, and that's tied to wage growth, and wage growth is slowly trending down. And what's left is housing inflation. Housing inflation is still high, but if we look at forward-leading indicators of where housing inflation is likely going, and that's the inflation of new rents, that new rental inflation has already come back down. So that suggests that housing inflation ought to come back down. Ultimately, we want to get inflation back down to our 2% target. We're not aiming to undershoot it, and so we do have to make some judgments about what is the path ahead for inflation, and that's going to be an important determinant on what we do with monetary policy.
Minneapolis Fed President Neil Kashkari speaking with Insight to Agro Hazinda Amin. Take a look at how some currencies are trading at the moment. We're seeing a little bit more upside for the Japanese yen against the U.S. dollar for second session already. We're seeing the euro also holding steady. And of course, this is after we had the euro rallying more than 1% at one point in the overnight session. Bearish conviction waning a little bit in the options markets. A lot to do with what's happening with the dollar itself, right? I mean, it fell by the most in more than 2 weeks before pairing some of that loss. The Treasury Secretary nomination of Scott Bessent really sending the dollar and U.S. yields sharply lower. Investors thinking that the Wall Street veteran will temper some of Donald Trump's policy proposals. Let's bring in Mahjabeen Zaman, head of FX research at ANZ Bank, for her take on the currency space. Mahjabeen, great to have you with us. We have a question of the day today from our colleagues, and the question is, does Scott Bessent or the Federal Reserve matter more to the U.S. dollar? What do you think?
Look, I think in the near term, the rally that we have seen in the dollar over the last, I would say, about 2 months was really the Trump trade and continued to maintain its strength as Trump was announcing his nominations. Clearly, Bessent seems to be a little bit moderate, so we have seen that pare back a little bit on the dollar. Broadly, I think the answer to this would likely be the Fed more than the nominations of the Treasury Secretary at this stage going forward into the trend of the dollar.
And we have seen, of course, the U.S. dollar really strengthen for the past 8 weeks. Its best run in over a year. How much of that is also a consequence of what's happening with the euro and that bearishness given the ECB rate cuts that are expected in that side of the world?
I think that's a great question. I think what we have seen, I think the pessimism around the euro area is very much extended when we look at, rate cut expectations. I think there might be some room for paring back of those, bringing the dollar USD a little bit weaker into year. And look, I think when we look at the dollar, at least on a tactical basis, pre-inauguration up to then, we're not really expecting any new news to come out from Trump. I mean, he's laid out his cards, his nominations, it's already been factored in. And I think between now and let's say early Jan, you're going to get the macro fundamentals really drive markets. And I think that really points to some paring back of the dollar strength that we have seen so far, especially with the Fed coming up.
A lot of that really driving what's happening with the Kiwi dollar and the Aussie dollar as well, right? We are expecting the RBNZ to cut rates this week, and the Kiwi dollar at one point this week really falling to that 2-year low against the Aussie. Is that a trend that's going to continue into 2025?
Look, I think that's a great question. Definitely looking into 2025, we definitely do see Aussie dollar outperformance over the Kiwi. I mean, just looking at rate divergence, RBA at this stage continues to look like they will be higher for longer. I mean, we have their first rate cut priced in only just in Feb. And obviously that depends on how inflation goes. But RBNZ is ahead of the curve in terms of their easing cycle. We are expecting a 50 basis points rate cut tomorrow. And so I think surely that rate divergence should play out positive for the Aussie-Kiwi pair into next year.
How are you calculating what the Bank of Korea will do this week?
Look, I think no action for now. We don't have much expectations around that.
Yeah, we have seen the Korean won see the best day in about a week, but given what we're seeing in currencies across Asia with the surging U.S. dollar, the Japanese yen is another one that has seen a lot of pressure recently. We are headed towards a BOJ rate decision in December. No change expected in December, perhaps a rate hike in January, but will that change the fate of the Japanese yen at all, given that a lot seems to be really dependent on what the Fed does anyways?
Yeah, look, I think that's a great point. We're actually calling for a hike in December. We are also waiting. I think this week we get to hear a little bit from the Rengo side of things in terms of what their expectations are for wages next year, FY25. And that will really shape our expectations for what the BOJ is going to do. Of course, with Japanese yen, it's really the yield differential that matters the most. On the US yield side of things, clearly, if Trump continues to, move out with his policies, we are likely going to be in a higher yield environment going forward, and that should somewhat give some support to the carry trades that we have seen, over the last 2 years, and that should weigh on the yen. We do think the yen would continue to be pressured with that, and we look at the yen to be at 148 into year end.
A weakness for the Chinese yuan as well?
Look, I think all of that is really pending to what Trump's policies play out. As at this stage, we do know that 730 is a line in the sand for dollar CNY. We have seen that being supported over the last year or two. We have not reached that yet, and I think it could be that China is just now waiting up to Inauguration Day to see what the policies are and then manage accordingly. And of course, there's also room for more fiscal support from that side as well.
Mahjabeen Zaman, who's the head of FX research at ANZ. We do have some breaking news when it comes to some comments that we're getting from President-elect Trump saying that he will charge China with an additional 10% in tariffs. Posting on his Truth social media platform, he's talking in particular when it comes to about having many discussions with China about the massive amounts of drugs in particular. Of course, the issues over fentanyl being sent to the United States. They're saying, the president-elect is saying that until such time as this is really fixed, they'll be charging China an additional 10% tariff above any additional tariffs on all of their many products coming into the United States. So not a great deal of detail, but of course tariffs and a potential revival of the trade tensions with China have really been one of the key concerns for economists and markets watching the incoming Trump administration in his second term. Of course, at the same time, we're also seeing Chinese exports to hit a record this year before the second Trump term, so perhaps a little bit of a buffer when it comes to the front loading that we've already seen of orders ahead of potentially higher tariffs. Export growth is really accelerating to push those export volumes to a record high, but also at the same time that prospect of a second trade war is expected to lead to more stimulus in China as well. We're hearing now of this 10% tariff over above any other tariffs that President-elect Trump will be adding on Chinese goods over the issue of fentanyl and drug inflows into the United States, which of course has been quite core to his campaign as well. More ahead on the Asia trade. This is Bloomberg. We continue to see President-elect Trump publishing more messages on his Truth social media platform. Of course, we heard earlier his intention to place a 10% tariff on all Chinese goods above and beyond any other tariffs that might already apply over the issue of the inflow of fentanyl and other illicit drugs into the United States. We're now seeing a separate post where he's talking about the imposition of additional tariffs when it comes to Canada and Mexico as well. President-elect Trump saying that he'll impose 25% tariffs on all Mexico as well as goods deriving from Canada as well, speaking about the thousands of people, and I quote, pouring through Mexico and Canada, bringing in crime and drugs at levels never seen before. So in terms of the details of this tariff, he's intending on January 20th as one of his many first executive orders to sign documents to charge Mexico and Canada a 25% tariff on all products coming into the United States. We are seeing a pretty significant move when it comes to the FX side of things in response to these messages. We're seeing the Aussie dollar reaction there. We're also seeing offshore yuan edging lower as well after his comment about the imposition of an additional 10% tariff on Chinese goods as well, Shery.
Which is really interesting because we had seen really the dollar plunging as well in the overnight session, given, of course, the nomination of Scott Bessent. And the expectation, Heidi, was that his tendency as a Wall Street veteran would be favoring less spending and more gradual tariffs. And yet we're seeing right now these lines over Truth Social about more tariffs right off the bat from President Trump, and currency markets reacting. And of course, another story that we're following at the moment, Bloomberg has learned that Tesla could be shut out from California consumer rebates on EVs, a proposal Elon Musk has described as, quote, insane. Our reporter Eliyahu Kamishar helped break this scoop and joins us now. So what's next?
Well, this is a proposal by Newsom. He can't do this unilaterally. He has to negotiate with the state legislature. So he's going to go to state lawmakers and say, I want to reboot this tax credit for electric vehicles if Trump does indeed rescind it, as they've indicated. And then they're going to hash out, is this program, who would qualify, and what car makers might be included or excluded. Newsom's proposal, as it stands, has a market capped structure, which would exclude Tesla. And I've asked their office if any other car makers would be excluded as well, but they have not gone back on that point.
What are the implications for Tesla?
Well, we're already seeing some analysis that this could be negative for Tesla. They are by far the largest electric vehicle producer in California and in the country, but they are seeing their market share slip a bit. And if other, smaller electric vehicle makers do have this incentive, buyers of those vehicles, that might kind of eat in a bit in California, which is the largest electric vehicle market in the country. So the purpose of, according to Newsom's office, the purpose of this rebate, excluding Tesla, would be to encourage competition of smaller electric vehicle makers, allow them to, quote, take root in the state, and that could eat into Tesla's market share in the state.
A Bloomberg News reporter Eliyahu Kamishar there. Well, UBS is planning to return to the Australian wealth management market after leaving more than a decade ago. It's aiming at high net worth individuals and family offices to grow its $30 billion in managed assets in Australia. Our finance reporter Harry Brockton broke this news and joins us now for more. So what do we know in terms of this scoop?
Well, it's been a very long time since UBS was last in the wealth market at scale. So when they exited it back in 2015, Heidi, on the proviso that there was just too much competition in the market, it was not a huge market for the bank globally. But since then that proved a misstep because Australia's wealth, high net worth individuals are growing at 7.5% last year. It's second only in the Asia Pac region to India, which is exploding at 12.5%. So, they were very fortunate in the fact that the shotgun marriage of Credit Suisse to UBS 2 years ago afforded them the opportunity to look through the the asset base of the business, and Australia, Credit Suisse had a very quickly growing and very strong wealth management business here in Australia that they've been able to, catapult back up to the top of the tables. But it's interesting. I mean, they're competing against local providers like Shaw & Co. and even Crestone, which was the management buyout spin-off from UBS in Australia here that then became part of LGT. So those former UBS managers that left the firm a decade ago are now managing nearly 30 billion themselves. So it's a competitive market, and they're up against big global banks as well, like Morgan Stanley and JP Morgan, which manage billions too for high net worth clients.
Are there specific demographics that they're targeting?
Yeah, there are. I mean, the big focus, and there's some really fast emerging niches in Australia as well as globally. One of the big areas is women's wealth is growing really quickly. So the number of women millionaires is growing at about 6% according to UBS versus about 3% for men. There's a few things driving that. I mean, not all of them happy. Some of them are the fact that we've seen a lot of billionaire breakups in Australia, like Mike Cannon-Brookes split with his wife Annie, and Twiggy Forrest has split with his wife Nicola. So those factors create instant billionaires. And then on top of that, you've got patriarchs, and succession, and often when they pass their wealth on to their wives and partners. Or even increasingly, what's really interesting is we are seeing, according to UBS, more of these portfolios being and businesses being handed down to daughters instead of just traditionally first sons. Women are getting more educated and more financially literate, and that's part of the process that UBS are tapping into here.
Yeah, we're finance reporter Harry Brumpton there. We do have breaking news at the moment. We're now hearing that Walmart is reversing course on diversity, equity, and inclusion initiatives, joining a growing list of businesses retreating on DEI programs targeted by conservative activists. Now, Walmart on Monday confirmed that it will stop using the term DEI in official communications. It will also curb racial equity training for staff, stop participating in notable rankings by LGBTQ advocacy group, the Human Rights Campaign, as well as reviewed support for Pride and other events. Now, the world's biggest retailer will no longer consider race and gender to boost diversity when granting supplier contracts and stop collecting demographic data when assessing financing eligibility. We have more ahead on the Asia Trade. This is Bloomberg. We have breaking news right now. The Japan October Services producer price numbers right now coming in at growth of 2.9% year-on-year for the month of October. This is actually coming in higher than economists had expected. It's also accelerating from the previous month. And this is a very important number for Japan because we are seeing signs of a broadening inflation trend. And that's really supporting the case for the Bank of Japan to raise interest rates. We know that the BOJ has highlighted service prices as a key measure for what they will do next. You can see the Japanese yen right now erasing some of those earlier gains against the U.S. dollar. You're seeing a lot of movement when it comes to currencies because we have heard from President-elect Donald Trump that he'll be adding 10% tariffs on Chinese goods, not to mention that he will be imposing 25% tariffs on all Mexico and Canadian goods. So you're seeing the Mexican peso take a hit against the U.S. dollar, while the Aussie is also losing ground. The offshore yuan down against the U.S. dollar, now trading at that 726 level, Heidi.
And of course, a lot of the outlook when it comes to commodities remains uncertain as well, right? Particularly when it comes to agricultural commodities, if we're talking about the implications of potential tariffs on a global scale. Coffee futures, Shery, close to our hearts always, of course, climbing to the highest since 1997 on these concerns about supply from top growers, including countries like Vietnam and Brazil. All of this threatening to further raise costs for roasters and ultimately for consumers. Let's get across to Sao Paulo, and our agriculture reporter Sayan Sousa joins us now. So, Diane, how much disruption is this rally pricing in, and what's the sort of situation when it comes to fundamentals?
Well, yeah, there's quite a lot of problems being priced in. To start with, we reached a peak in coffee prices this Monday, but they have been climbing since the start of the year. And There are multiple reasons. Mainly at the start of the year, the biggest concern was Vietnam. There was a big drought and the production was really disappointing. And now the focus has shifted to Brazil, which is the world's largest producer and has also been facing several weather issues. And there's a lot of uncertainty on what's the crop going to look like.
What does this mean then for coffee production for next year?
Oh, yeah. The only certainty at this point is there's going to be a loss. How big is it going to be? People are still debating. Brazil has just gone through its worst drought on record. Since April through September, almost no rains were seen over the coffee regions. And there's a saying that coffee trees have memory. And even as the rains have later arrived, it is not enough to offset some of the damage. And so they will show issues and probably not going to reach the full crop potential for the harvest that starts about May next year.
Agriculture reporter Diane Souza there in Sao Paulo. Let's take a look at what we're seeing, which are pretty significant moves across FX markets, particularly when it comes to offshore yuan, as well as the yen, and the move that we see in the Mexican peso as well. We have seen really a flurry of announcements from President-elect Trump when it comes to his intention to impose an additional 10% tariff on Chinese goods going into the United States, above and beyond what any other tariffs presumably he would be considering on that bilateral trade relationship. We're also seeing a separate announcement when it comes to the imposition of potentially 25% tariffs on all Mexico and goods coming from Canada as well. A lot of this is to do with what he refers to as the drug trade, as well as the crime, the cross-border crime. But when it comes to China in particular, it is his grievance when it comes to what he sees as the fentanyl issue and incoming flows of drugs. This is Bloomberg.
This is the Asia trade. We're counting down to Asia's major market opens and perhaps some big gyrations in the market, Haidi, given the president-elect Donald Trump has already, not even having taken office just yet, announced additional tariffs on Chinese goods of 10%, Canadian and Mexican goods of 25%. What a difference that has made in the mood in the markets. Overnight, we were encouraged by Scott Bessent's nomination as Treasury Secretary that he might be able to temper some of Donald Trump's policies.
Shery, in a way, I feel sort of conflicted about this, right? Because on the one hand, none of this should be surprising. This was all part of his core campaign rhetoric heading into the election. Of course, right down to these specific companies, countries, I should say, that there's grievances with. But on the other, you can clearly see there's been some complacency on that Trump trade.
Yeah, you're seeing the reaction in the Japanese yen as well, curbing those gains that we had seen earlier against the U.S. dollar, because overnight, with Bessent's nomination, we had seen the dollar actually fall, Treasury yields fall, take really much lower in the overnight session. So we had seen a little bit of strength for the Japanese yen, which has really been taken away from the markets, and we're back above that 154 level. When it comes to the Nikkei, curbing 2 sessions of gains already to fall 0.6%. We did get the services PPI numbers out of Japan for the month of October, accelerating more than economists had expected, and also accelerating from the previous month, which just comes to show you that perhaps we are seeing the broadening of inflation trends here in Japan, something that the Bank of Japan has said they will keep a close eye on as we head towards that December rate decision. Take a look at how the Kospi is also coming online right now, because we had seen the Korean won trading at that 1,400 level, and we're seeing more significant weakness against the U.S. dollar, while the tech-heavy Kosdaq not doing much, but the Kospi, you can see right there, falling 0.6%, Heidi.
Take a look at, Shery, the reaction that we're seeing across Australia. And I should point out, when it comes to that initial reaction, the Aussie dollar is also one to watch when it comes to these tariff signals, given that, of course, we see the Aussie and some of these Australian risk assets are playing that sort of China proxy role as well. So vulnerable the economy is to its largest trading partner. At the same time, of course, exports for China in terms of volumes have been inching closer to that record high. But take a look at the sort of risk appetite. Not a lot of it. We're seeing ASX 200 equities, that picture there, off by about 0.25%. Banks are retreating. We're seeing energy shares retreating. We're seeing ASX shares in itself also falling after the cost of its CHESS system were flagged at the upper end of the guidance. The sort of a computer upgrade costs there playing a big part in how we're seeing that stock trade at the moment. And taking a look at treasuries there as well, we're also seeing Australia 10-year real yields headed for that 5-week low as well, sort of adjusted for CPI linker break-evens, headed for a third daily fall there. Watching also some of the gold and oil names as well, gold miners, oil stocks as well, really in focus given some of those declines we see in light of a potential ceasefire getting closer between Israel and Hezbollah. And as I mentioned, we have seen that reaction when it comes to some of the sensitive currencies that are related there. Shery went through the moves when it comes to dollar yen, dollar China, seeing a pretty significant move. The Aussie dollar now under 65 US cents there, at a pretty big move, although not as much as what we saw earlier off those session lows now for the Mexican peso. Let's bring in the latest with our Chief North Asia correspondent, Stephen Angle, in Hong Kong. So, Steve, you know, it's sort of hard to know what to make of this because, in a way, not a lot of this is surprising. We know that this is kind of Trump's bread and butter.
Yeah, but he's getting a head start on his second term in the White House. Obviously, not until the end of January is when he becomes president again. But he's getting a jump on that in November, obviously 3 weeks or so after his election victory. In two different posts that followed up each other on Truth social media platform. Let me just read you his first one, because this will give you the nuts and bolts of what he is saying. He says, "I've had many talks with China about the massive amounts of drugs, in particular fentanyl, being sent into the United States, but to no avail. Representatives of China told me they would institute their maximum penalty, that of death, for any drug dealers caught doing this, but unfortunately they never followed through, and drugs are pouring into the United States, mostly through Mexico, at levels never seen before. Until such time as they stop, we will be charging China an additional 10% tariff above any additional tariffs on all of their many products coming into the United States of America." He followed that up with another message, essentially also blasting neighbors Mexico and Canada, saying that he would vow to hit those countries with an additional 25% tariff on all products, saying he would sign that executive order to be in effect on his first day in office. Again, the issue with Mexico and Canada, again, he was saying not only on the drugs, but also illegal immigrants coming into the United States, which, of course, was a massive part of his election campaign. So again, we're seeing, as Shery just said and Haidi just said, immediate currency reaction with the yuan falling, as well as the Mexican peso and the Canadian dollar. We'll have to see how this follows up, but he is very clear in his comments well before he's even into the White House.
And when it comes to China, we have already seen a lot of pressure, especially around the war in Ukraine. What do we know about that?
That's right. So you have the G7 foreign ministers meeting in Italy right now. These over Monday and Tuesday. They are drafting a communique in addition to what we're seeing from the EC, the European Commission, according to documents seen by Bloomberg, that the EU is looking at its 15th round of sanctions against not only Russia, but also entities, some nearly 50 entities, or more than 50 entities, and nearly 30 different countries. So individuals and countries that are allegedly aiding the war in Ukraine, including the EU action proposing to sanction several Chinese firms that it claims have helped Russian companies develop attack drones that have been deployed against Ukraine. This, according to those documents, again, seen by Bloomberg. Bloomberg did report back in July, if you remember, that Chinese and Russian companies are allegedly developing attack drones similar to those made by Iran that have been found on the Ukrainian battlefield. So this is just one part of the EU sanctions that could still, of course, change, but that it's clear not only the G7 but the European Commission, the executive arm of the European Union, obviously, is bolstering its support of Ukraine and cracking down on ways Russia can potentially put new weapons on the battlefield and fund its war machine, as the G7 draft communique says, going forward at a time when Donald Trump has expressed his skepticism about continued U.S. support for Ukraine in that war. So this is a developing story. We'll have to see if these draft proposals, not only by the EC, but also the G7, which wraps up its two-day gathering Tuesday in Italy, whether those communiques and those sanctions from the EU have the kind of teeth that are in the draft documents right now. Keep in mind, any new sanctions proposed by the EU would have to be approved by all 27 member nations.
Our Chief North Asia correspondent Stephen Engel there. In the markets, the mood decisively turning negative at this point. We're seeing every major market trading early in the Asian session down. This, of course, as we got those news about potential tariffs coming from President-elect Donald Trump. Let's bring in Kelvin Tay, Regional CIO at UBS Global Wealth Management. Kelvin, good to have you with us. I mean, this is almost like deja vu, right? Is it 2017 again? So I kind of feel like we shouldn't necessarily be that surprised. We have been hearing about tariff talks for a while, and yet the market reaction is so swift. Is this going to be what the next 4 years looks like?
Yeah, I mean, the new administration will likely be very transactional and unpredictable in its dealings with the rest of the world, actually, unfortunately. And I think we can sort of like telegraph what they are likely to do. Now, the announcement of the tariffs against China is not surprising. What's surprising is that it's only at 10% and not more than that. But I do think that going forward, any more tariffs coming in against China will likely be more new ones because of the fact that some of the goods that China exports to the US doesn't have ready-made substitutes anywhere across the world. So if you impose that on China and you still have to buy on China, that can only mean one thing, that your prices on the domestic market in the US will go up, inflation will follow through, and that at the end of the day will basically result in higher interest rates and higher yields, which the US doesn't want, right? Because President Donald Trump-elect has said on many occasions that he doesn't want the dollar to be too strong. So I think there's a bit of an overreaction on the market where this is concerned, and I think after the noise settles, there'll be a closer look at what these potential tariffs can actually do to inflation in the US.
When it comes to that noise, though, I mean, this is President Trump's strategy, that shock and awe strategy, whether it's the markets, whether it's military and defense. How should investors what should investors focus on in the next 4 years, especially as we head towards 2025? And we do have a Fed decision coming up in December as well. What will be important when it comes to the fundamentals?
I think if you look at the fundamentals of the US companies listed on the S&P, the fundamentals are actually pretty good, right? I mean, if you take a step backwards and you look at the whole situation, you have firstly the interest rate cuts still coming through, largely because of the fact that, the Fed is data dependent on current data and not trying to predict what the data will be after the tariffs actually come in. So if we look at all the core PCE numbers, the labor market and consumer spending, etc., those numbers seem to point to the fact that inflation as measured by core PCE will likely trend towards the 2% target by the end of 2025. And if that's the case, then the impetus is actually on the Fed to actually continue cutting rates from here until I would say at least the third quarter of next year. On top of that, you have President Donald-elect Donald Trump's pledges to actually bring the corporate tax rate down to 15%. So if you combine those two together, that basically means that corporate America is likely to be in pretty good health, and therefore, where the US equity market is concerned, we do see potential upside where the S&P is concerned. So taking a step backwards and looking at your asset allocation, we do think that the S&P will likely do pretty well in 2025.
What about currencies? Because we're seeing the dollar now extending the gain on this news. We're seeing the Loonie down. Obviously, the Aussie dollar is down. The moves across the Mexican peso and the yuan as well. Is it sort of a one-way track then when it comes to the greenback? And what are the sort of implications you see for Asia, emerging Asia in particular?
Yeah, I think where the dollar is concerned, it's probably likely to be a case of stronger for longer. We do think that where the euro dollar is concerned, the dollar will likely remain in a pretty tight range, and unfortunately, it's not probably going to get beyond 106 against the euro. The European Union, I think, is probably the biggest net loser out of this whole situation, largely because of the fact that you have the Russia-Ukraine war on the one hand, and on top of the other, you also have President-elect Donald Trump threatening to actually increase tariffs or put more tariffs on the European Union exports. And that's something that the European Union cannot afford to have at this point in time, given the structural issues that, one of its biggest economies, Germany, has within the economy itself. So if those tariffs really do come in, then obviously Europe is going to struggle, and they're going to struggle and they're going to limp along, right? Growth rates of 0.5 to 0.8% for 2025. And on top of that, you have potentially higher bond yields as a result of, issuing more bonds to finance the Russia-Ukraine war. So if that happens, then obviously the European Union will be in a far more disadvantageous position relative to other currencies. But again, if you look at the dollar against the other currencies, with the US Treasury yields even at 4.27%, the dollar will likely be stronger as a result of that.
Reading through your notes, and it's interesting, China internet stocks is one that you're still constructive on, and it hasn't been that exciting in terms of the pretty negative reaction to earnings. But it kind of leads to an interesting investing thematic, right? If the assumption is that external pressures will make China's stimulus perhaps be more aggressive, is that a good enough reason to look for those Chinese domestically oriented opportunities?
Yeah, I think a lot of the policies that have actually been initiated in 2024 have been geared towards the consumer market. I mean, if you look at the cutting of the mortgage rates, the cutting of the lending rates, and even the cutting of the deposit rates, it seems to send a signal that the Chinese government is trying to actually stimulate the consumer market. But, let's make it clear. The consumption will not improve unless we get an improvement in the property market itself. And I think there was a bit of a holdback where the Chinese government was concerned with regards to the latest round of stimulus. The local government debt swap is a positive development in the right direction, but unfortunately it does not go far enough where the size is concerned in our view. And we do believe that they need to actually do more to try to actually reverse the slump in the property market. Now, thus far, we're quite encouraged to see that the weekly property sales numbers have been improving, but it's improving at a snail's pace, right? And that's not likely to actually change the direction of the Chinese equities market at this point in time. We do need to see far more stimulus measures coming through, addressing directly the property market. And if that happens, then obviously sentiment will improve further, and consumption then perhaps can actually improve from there.
We're seeing a lot of stimulus measures here in Japan. Of course, we had the new economic stimulus package of $140 billion already by Prime Minister Ishiba. What do you make of this market, especially at a time when the Japanese yen is also weak and we're headed towards a potential rate hike coming from the BOJ in the next 2 months?
Yeah, I'm a little bit more skeptical in Japan because I think where the Japanese equities market is concerned, it's all largely due to a very weak yen. And the yen is likely to come under increasing scrutiny from the US Treasury once President-elect Donald Trump takes over officially, largely because of the fact that the yen is too weak vis-a-vis its purchasing power parity against the US dollar. So potentially Japan could also face some tariffs on the sidelines as a result of that. Now, on top of that, where Prime Minister Ishiba is concerned, he can't afford to be too dovish on the Japanese yen, given the fact that the LDP almost lost the elections due to very high inflationary pressure at home. So I think he is likely to actually adopt a more neutral to perhaps a slightly more hawkish tone where the Japanese yen is concerned. And if that happens, then it's very, very difficult to actually envisage the Japanese equities market performing further from here, given the fact that, the Japanese yen is not going to be allowed to actually breach the 162 against the US dollar line again. I think that's a line across the sand that they cannot afford to actually cross. And when that happens, then obviously the Japanese equities market will go up very strongly. So if the Japanese yen strengthens further from here, and we do think that it's likely to strengthen to the 145 level, then obviously that's going to be a big obstacle for Japanese equities.
Kelvin, hi. Good to have you with us. Regional CIO at UBS Global Wealth Management. As we continue to keep an eye on FX markets right now, we're seeing the offshore yuan fall to a 4-month low against the U.S. dollar. Of course, we heard from President-elect Donald Trump on an additional 10% tariff on Chinese goods. We're seeing the Mexican peso also lose ground against the U.S. dollar. We're expecting 25% tariffs as announced by President-elect Trump there, and we continue to see the downside. This is Bloomberg. Take a look at how commodities are trading at the moment. We had seen oil dropping in the previous session, and we continue the plunge downwards 0.4%. And New York crude right now towards that $68 a barrel. Of course, we have a little bit of light pre-holiday trading. It's Thanksgiving week in the U.S., but also diminishing risks from the Middle East conflict. Of course, not to mention that we're headed towards the OPEC Plus meeting this weekend as well. We will be watching whether their planned output increases next year actually go ahead. We're watching iron ore and copper prices as well. We have seen significant downside pressure in the commodity space, given not only concerns about China, geopolitics, and of course now we have more news coming from President-elect Trump about these additional tariffs on China. But as I mentioned, really it was about the risks from the conflict in the Middle East and how investors were weighing that diminished risk. Let's get more from Bloomberg senior energy reporter Stephen Stepchinsky. Stephen, good to have you with us. Of course, we're factoring in geopolitics. Now we have to factor in potential slowing global demand if we get more tariffs. What are you watching?
I think one thing to watch are the Israel-Hezbollah peace negotiations. I think there has been an ambassador to the U.S. ambassador to Israel had said that there was some progress there and that those talks could result in some sort of pact or agreement. If we do see some sort of ratcheting down of pressure or some sort of agreement between Israel, Hezbollah, and maybe other groups, then you will see this risk premium that had been a feature in the oil market start to disappear. Now, when you're seeing oil prices rise, especially over the last few weeks and months, it's most often due to headlines that come through on conflict either in the Middle East in relation to Israel or because of things that are happening with Russia, Ukraine. So if you remove this threat of further conflict in the Middle East, which is a major producer of oil, you're going to quickly see a lot of that risk premium sort of dissipate, and then focus on the fundamentals, which you alluded to, which is next year we're looking at an oversupply. So then from that section, we're going to have to look at what OPEC Plus says in their next meeting coming up.
And that's going to be a real tone-setting meeting, right? What are the expectations at this point?
So actually, there was an interesting op-ed from an Iranian official that said essentially it was difficult to bring barrels back to the market. OPEC Plus had delayed production increases for the last few meetings, and they're expected to again maybe have a small delay again. The issue with this lies in just the global nature of the oil market. Years ago, OPEC Plus, they were the largest producer. They could swing things either up or down. Now with U.S. shale still quite resilient, that's replacing potentially some of the supply that's coming out of the Middle East. It's adding more froth to the market. So when OPEC Plus is kind of crunching the numbers and looking at the balance for 2025, it doesn't make a ton of sense to add barrels, especially when shale output is so strong and the demand elsewhere isn't as high to help kind of take away those barrels from the market and kind of suck up that supply.
Bloomberg senior energy reporter Stephen Stepchinsky there. More ahead on the Asia trade. This is Bloomberg.
Total says it won't make any fresh investment in Indian conglomerate Adani Group until U.S. bribery indictments have been clarified. It's the latest sign that founder Gautam Adani's global ambitions may now be in peril as he faces potentially years of litigation. Bloomberg's legal enterprise reporter Patricia Hurtado joins us now. Patricia, so how serious is this case brought forward by U.S. federal prosecutors? What can you tell us?
Well, it is a pretty serious case. I mean, the United States government has put its wherewithal in the Justice Department to charge Adani and 7 other people. And these are very serious charges that Mr. Adani faces. 3 counts, one a securities fraud count, one a conspiracy count to commit securities fraud, and a conspiracy to commit wire fraud, all which carry a maximum of 20 years in prison. It's not going to be easy for either side. The U.S. government is going to have to pursue this case as if it's had the long arm of the law to reach across the waters to India and try to extradite Mr. Adani. And of course, Mr. Adani has that in his benefit, that he could fight extradition and probably use any allies he has in India to keep him safe in India.
What could it mean ultimately for Gautam Adani? Are we talking about extradition here?
Yes, and what has happened in the past, sounds unusual, but the U.S. will seek extradition from a country, and the country will then decide whether or not there are comparable crimes in their law that have been violated. Obviously, bribery, they'll have to look at all of the allegations, including securities fraud and wire fraud, to find out if there's similar crimes or comparable crimes. And then they're going to ask a magistrate in India to make a decision. In the United Kingdom, we've had incidences where extradition has taken years. We had a case from South Africa where the former Mozambique finance minister, it took 41 months to get him extradited to Brooklyn, New York, for prosecution by the same people who are prosecuting Mr. Adani.
Yeah, tell us about the federal prosecutors in Brooklyn, how they're claiming this case.
Yeah, it's an interesting theory. There are back offices in Brooklyn, New York, where the prosecutors are located, and there are banking offices, back offices, located just half a mile away from the courthouse. And the transactions have gone from, they're arguing that there were bond offerings that were offered to American investors, and the American investors were the ones that were victimized and defrauded by Mr. Adani in this scheme. So the transactions and the bond offerings went through American financial institutions, and they actually went through from basically where banks are located in Manhattan, as well as back offices in Brooklyn.
Bloomberg's legal enterprise reporter Patricia Hurtado. More ahead on the Asia trade. This is Bloomberg.
Right, take a look at a big mover in the Tokyo session. Nissan down more than 3% at one point. Local media reports now saying that Nissan will reduce its U.S. output by 17% through the end of March compared to a year earlier. This is an extension of ongoing production cuts. Nissan had already decided to reduce output at 2 factories. They're operating 4 days a week instead of 5. Suppliers have been informed, so we're now seeing those extension of U.S. production cuts and the stock losing more than 3%, Haidi.
To be fair, Shery, misery, he's joined by just about every other risk asset at the moment, other than, of course, the US dollar that we're seeing broadly stronger on Trump's tariff plans. The second time around, we're seeing that retreat across Mexican peso, unsurprisingly, the Loonie as well leading some of those losses, offshore yuan, as well as the China proxy seen across the Aussie dollar as well. Let's get more on the market reaction to the President-elect's latest tariff announcements for China, for Canada and Mexico. Bloomberg FX and rate strategist David Finnerty is here in Sydney with us. Really great to have you with us. So this is welcome to the next 4 years of trading on headlines again?
Yeah, I think you had to expect that now. He had a history when we went into his first presidency of these late night tweets or something in terms of US, which happened during Asian hours. So I think he's already shown that that's going to be a behaviour that's going to continue again. So in Asian trade, it's going to be very alert. Obviously, we've seen a big dollar rally on this, with the real ones that have been hurt are the Mexican peso and Canadian dollar, really affecting it because of that 25% tariffs which has been imposed. I think what's going to be interesting is when actually will they be imposed, the market be looking for. But certainly the knee-jerk reaction is buy the dollar again.
And it is a knee-jerk reaction. I mean, the Loonie, biggest intraday loss in more than 2 years. Is that interesting to you, given that the content, the direction of what he's saying, we knew all this from his campaign. This is not kind of shocking.
No, I think that's a good point. It said it was already well known. There's no surprise of the tariffs. I think what's interesting is the market's gone. He's come out already.
Yeah.
And he didn't even wait till he was in office to actually start announcing it. So he's going to hit the ground running hard, shall we say. So I think the market's reacting to that because you go, if he's announcing this, what else would he announce? How soon will they be implemented? So the debates of it sounds like everything's to be sooner rather than later is certainly the message the market's taken away from this.
Will we go back to fundamentals, though, David? Because I remember the Mexican peso also took a huge hit in the beginning days of the Trump presidency, Trump 1.0. But then at the end of the presidency, it actually ended up strengthening given some of his policies. So how much will fundamentals eventually matter for these next 4 years anyways?
Yeah, I think at the end of the day, fundamentals will certainly be key. I mean, at the end of the day, the tariffs are going to come in. We want to see, look, how does the Fed react to this? Does it affect the decision going forward? Because previously they're like, well, we don't know exactly what's going to happen. Now we have a bit more information. So the question is, do they cut next month? Do they not cut next month? How much will they cut? And at the end of the day, that Fed policy is really going to be, and the other central banks' policies will be the real key driver of where the dollar goes in the near term. I think if you remember going back to Donald Trump's first presidency, the dollar rallied after his initial election win, and then actually when he took office, the dollar weakened. Now, having said that, he didn't impose tariffs quite quickly as it looks like he will now. But certainly the point is there are other variables besides just Donald Trump's tariff policy. But at the moment, that's the one that market is focused on. But we're interested to see what the Fed says at its next meeting, how it wants to react to it.
Not to mention that President Trump doesn't necessarily like weak foreign currencies, right? He thinks that is actually not good for the U.S. competitiveness, that they cannot compete when it comes to export sales. What he said during an interview with Bloomberg before about the Japanese yen being too weak, that's still that's something that has caught my eye. Is that the sort of rhetoric and the sort of dynamic that we'll continue to see in the next 4 years?
I think it's certainly a possibility. I mean, the fact that he's already alluded to other currencies being weak. Of course, the irony is that his policy is actually making the dollar strong. So the other countries can go, well, it's actually your policies that are actually triggering this, not us. But I think that won't stop him from saying that other currencies are too weak or maybe that they're intervening too much. I think the Treasury watch list of currencies that come out for monitored for which ones have been intervening too much will be very interesting moving forward under Scott Bessent, and how much he listens to Donald Trump as well. So I do think that rhetoric will continue, but look, at the end of the day, a lot of the other countries will say, look, it's actually the US policy that is triggering the strong dollar and hence the weak currencies and not their policies.
Yeah, how quickly the market mood has changed from that Bessent nomination, right? Bloomberg FX and rate strategist David Finnerty there. Now, earlier, we also asked Minneapolis Fed President Neil Kashkari about how Trump's previous tariff threats could affect global trade and his views on Beijing's battle to revive their economy as well. So take a listen.
There's obviously the risks of potential tariffs back and forth between the U.S. and China, which are notable. The other big concern is just the domestic Chinese economy and the slumber that it appears to be in. From our analysis, the heavy weight of the housing sector that has been a driver of Chinese growth for so many years is now appears to be weighing down the Chinese economy and just the struggles that the Chinese economy is facing. And so I'm just something that I'm watching a lot is what the policymakers in China do, and can they get the Chinese economy on a stronger, sustainable growth path, reinflating, so to speak, their housing bubble doesn't seem like it's a long-term strategy. So what is China's growth strategy? I agree the potential tariffs between the U.S. and China and back and forth is something to pay close attention to. But I think China's own domestic challenges are also notable.
Do you think that if China's economy remains lackluster, we could see some contagion and other Asian economies and perhaps even further afield may get impacted as well?
Certainly possible. I mean, China is obviously a huge economy, and if a huge part of the global economy just grows slowly, that's obviously going to have an imprint on everybody else. For example, commodity markets would be one of the first places that we would see that, whether it's for steel or for iron ore or other metals or other minerals. So that's something that we're going to pay close attention to because it just matters a lot for the global economy. But then I also think many other Asian economies are linked to economies all around the world. I was just looking at some analysis on where the U.S. imports most of its goods. Of course, China dominated that 6-10 years ago, and China's share exporting directly to the U.S. has actually fallen quite a bit. And countries like Mexico and other Southeastern Asian countries have picked up the slack. And so I'm actually optimistic that other Asian economies could continue to perform well because they're connected to the U.S., they're connected to Europe, to South America. But of course, China is just so large that what happens in China matters to everybody.
Minneapolis Fed President Neil Kashkari there speaking with Inside anchor Haslinda Amin as we continue to see the offshore yuan at the moment under pressure, a 4-month low against the U.S. dollar. In fact, Asian stocks seeing the worst day in about a week. The Nikkei down more than 1% right now. The energy sector is the biggest loser at the moment. This, of course, on overnight news. We already had oil dropping given easing geopolitical tensions. But again, now we have this risk of a sort of sentiment, not to mention that the U.S. dollar is surging on those tariff news coming from President-elect Donald Trump. So that's really putting additional pressure on commodities prices. The Kospi and the ASX 200 also down. This is Bloomberg.
Australia's Parliament has just 2 sitting days left this year, with the Albanese government still trying to pass major pieces of legislation ahead of a looming election. Bloomberg's Paul Allen joins us now for more. It's going to be a frantic 48 hours in Canberra. What's left on the to-do list?
Plenty. There's 30 bills in front of the Senate this week, including some really major ones, and 48 hours to get it all done. These include migration, aged care, tax credits for critical minerals. The government's going to be relying on the crossbench to get a lot of this done. And already we've had one independent senator, David Pocock, saying, look, this is too rushed. It's happening too quickly. We need more time to consider this. For example, we were talking about the social media bill yesterday that's going to ban access for people under 16. The polls suggest that this is a very well-supported idea, but now the rush around it is starting to raise all sorts of questions about how well thought out it is and how effective it is, and that's starting to sort of bleed into the narrative. But a few key things have been done. Housing affordability, obviously a big issue here. The Help to Buy housing scheme finally made it through the Senate with the support of the Greens after they dropped their long-standing opposition. The crackdown on gambling advertising, though, has been shelved. There's even a bill on elections coming up that's going to place a cap on political donations and faster disclosure as well. So an enormous amount to get done.
Is this about clearing the decks before the end of the year? I mean, we know that feeling, or is it about getting things done before it gets complicated before an election?
It is the feeling, right? And it is that time of year when we start to go, when's it going to happen? Because the election has to happen before May the 17th. So if we take a look at the proposed sitting calendar for next year, there's a budget penciled in for March the 25th, which is earlier than usual, which suggests, okay, well, maybe it's going to happen in May. But the economy is shaping up to be a bit of a problem for the government as well. Deloitte has forecast a larger than expected budget deficit of more than 33 billion Aussie dollars. The Treasurer, Jim Chalmers, did signal that the budget would be slipping back into deficit. But we've got a whole lot of other issues as well. Inflation obviously sticky. The Reserve Bank of Australia unwilling to cut rates. The polls are really, really tight at the moment, so the economy is shaping up as a major issue.
Paul Allen in Sydney. And let's get some more when it comes to Australia's political landscape, with the switch being flipped to election mode. Joining us now is Andrea Carson, who's a professor of political communication at La Trobe University. Andrea, great to have you with us. And, you know, as Paul sort of highlighted, some of the key issues are no-brainers for the voters, right? The cost of living, housing affordability, and, you know, potentially where the sort of fiscal and monetary policy landscape goes from here. What do you think is going to be the biggest struggle for this government?
I think you've summed it up nicely. It's going to be cost of living pressures, getting inflation under control, and housing affordability. Anything economic is going to be front of mind for the voters. And we've seen a little taste of that already looking at the US election and the result there, which economic issues were definitely very salient and at the front of mind of voters in the US. And I think we'll see the same pattern here in Australia.
It's interesting you talk about, you know, obviously a lot of these are global issues, not particular to Australia. Do you think we'll see the same sort of populist discontent? I mean, we've seen with the likes of Queensland, for example, that any kind of attempt to revive a US-style abortion debate has backfired.
Yeah, that's true. I think the US election, Australians increasingly watch US politics, and certainly Australian politicians do. I think the triumph of Trump will embolden some Australian politicians to take more populist rhetoric to the electorate. Abortion, perhaps not so much so. I mean, one of the things we do have in Australia is compulsory voting, which means that we do temper those extreme ends, something that they don't have in the US, where voting isn't compulsory, and so the more radical views get significant airplay. So I think that may not come to play as much with abortion, but I think it will definitely be true when it comes to economic issues and cost of living.
We've already seen President-elect Trump announcing tariffs today on China, not to mention Mexico and Canada. As we head towards a busy political season in Australia, how difficult and challenging will the communication be for the Albanese government to really stay focused on domestic issues when you also have a lot of geopolitical noise?
Well, that's right. And we've just heard from your previous correspondent that the Reserve Bank is not likely to reduce interest rates. And this tariff announcement, which we saw coming the moment that Trump was elected, he made no secret that that is one of his key priorities. Australia might be in a fortunate position because we do have a trading deficit with America and a good relationship with the country, but it will require a lot of behind-the-scenes diplomatic efforts to try and scope Australia out and have tariff exemptions. If not, it will have a real impact on the Australian economy, and it will through third-party measures also with our relationship with China, which will be penalised with this tariff announcement. And of course, we rely very heavily on trade relationships with China. So none of this will be good news for the Albanese government as it's heading into an election season. It could be as close as 3 to 4 months away and having a fairly precarious economic backdrop.
Even today, we saw news about the changing narrative in the U.S. For example, Walmart dropping its initiatives around diversity and inclusion, dropping the word DEI in official communications. When it comes to Australia, how much coverage are we getting when it comes to these more extreme right-wing parties that want to really enhance that sort of narrative?
Well, there's a very anti-woke culture going on in some segments of the US, and we will, as we often do, Australia is usually about 1 or 2 election cycles behind the US. We're already seeing some of that anti-woke, in inverted commas, language coming into the Australian media with some commentators that are sympathetic to the Trump agenda here. So I think as we go into the next election campaign, there will be some politicians emboldened by Trump's victory and will be using similar types of narratives.
We've seen how the governments, Western governments, have handled the ongoing war in Gaza, the humanitarian crisis that's been still playing out there. Certainly have an impact in the US, where a significant number of voters either went third party for the likes of Jill Stein or refrained from voting in protest. Do you expect that to play a significant part in Australia, because there has been some discontent on how our Foreign Ministry and the government has responded to?
Yes, I think this will be central for some electorates that have large diasporas of Muslim voters. I'm thinking of areas like Western Sydney, Tony Burke's electorate with the Albanese government. They'll be very concerned, I think, about how they try and bring those voters back into the net, traditionally Labor voters. But as you say, in the US, some of these people were feeling very disenchanted and were going for third-party options. And I think that will be another challenge for the Albanese government heading into the election.
Andrea Carson, Professor of Political Communication at the Department of Politics, Media and Philosophy at La Trobe University. We do have more on Australia Ahead every Tuesday at 11:40 a.m. if you're watching in Sydney, 8:40 a.m. if you're catching us from Hong Kong. Take a look at what we're watching when it comes to trading in Australian assets. And of course, we've been speaking about really the outsized moves across FX in response to President-elect Trump really getting a head start when it comes to his tariff campaign. Right on his agenda are tariffs against China as well as Canada and Mexico. We've seen that sort of proxy reaction, the weakness in the Aussie dollar. 64.57 is where we're at, which often trades as that proxy to vulnerabilities for the Chinese economy, of course, front and centre in a potential trade war again with the United States. Equities also seeing downside, energy and banks dragging that lower, about 0.3%. Also watching oil producers as well as gold miners, given some of those declines that we've seen on the potential for a ceasefire in the Middle East between Israel and Hezbollah. Also watching Kiwi assets ahead of the RBN said they're set to join that aggressive rate cut cycle with a second big move on Wednesday. More ahead on the Asia trade. This is Bloomberg.
U.S. futures right now under pressure. Of course, we just heard from President-elect Donald Trump on additional tariffs on China, not to mention 25% tariffs on Mexico and Canada. Morgan Stanley's chief U.S. equity strategist, Mike Wilson, says it's hard to be uber-bullish right now because there's so much political angst in the country. But he says earnings remain a bright spot.
We've been excited about this for 6 months. It's just now we can kind of see it in a way where we can see a broadening out. We see it in the numbers, right? We've been waiting for this. So in the last 2 quarters, we've actually seen a broadening out of the earnings story for the first time, even before the election outcome. Okay, so this is a 2-step process. It's going to be noisy. Stocks are expensive. Okay, that's something we have to understand. The markets are ahead of this already. Let's not think that we're discovering the light bulb here. Okay, the markets have already done this. So, but yes, I think there's a wider path now, a wider set of opportunities, which to me is more exciting.
You've spent a lot of time speaking to clients over the last few months, I'm sure, about the outlook for 2025. What are they most skeptical about? What's the biggest pushback you get?
Well, valuation has been, I've been skeptical on that, quite frankly. So it's still, people are uncomfortable with the valuation in the equity markets. But then when you think about, well, what else is there out there? And then you look at the U.S. versus other markets too. So that's probably the biggest one. The second one is just, it still feels unstable. Like geopolitics, the political, angst in this country is like not resolved. There's still this very bifurcated political environment. People's economic situations are very bifurcated. That makes people uncomfortable. So I think that's the part that people it's hard to get uber bullish when you have all these things that are kind of holding you back.
Do you sense that some clients, and of course you're not going to name any, but do you sense that some are finding it difficult to divorce their political bias away from their economic views? Have they learned the lesson of 2016-17?
Most clients are more objective. Investment clients are more objective about that because they have to be, right? Because there's this thing called the price. that makes them be objective about the outcome. That doesn't mean they don't hold personal biases. We all do. That's natural. I do think 2016 maybe changed that a bit, but look, we're all forced to perform, and whether it's a political bias or it's a style bias, you have to navigate that and be flexible.
Just to put a bow on this conversation, the essence of this conversation when you talked about the administration was the real potential for real change. When I asked you about whether some of these clients are sceptical about 2025, are they sceptical about anything in the administration's agenda that you think maybe they should be paying more attention to?
Well, we wrote about this weekend. I mean, there's a tremendous amount of skepticism on whether they can actually streamline the government, because it's just, I mean, people have tried this before. This is not like a new idea, right? So it's difficult. I mean, and we all know about these roadblocks that are kind of built into the system, that, the appropriations, the way you get the money that have to be spent, the civil liberties laws, which are good laws to protect people's rights on jobs. But it's almost like you're fighting against this giant blob, and people are very skeptical that you can beat the blob. And I think that's an area where we need to be a little bit more open-minded. I'm more open-minded about that, because this is what the American people want. When I forget about talking to investment clients, when I talk to people on the ground, people look at the government and they say, hey, government does a lot of great things for me, okay? But I have to worry about my job all the time. I have to operate in a different world. Why should they be operating in a different environment? I just think there's opportunity. And this is also potentially liberating for people in the government. There are really good employees in the government, okay? They just play for a bad team. It's like, let's take a good player on a bad team and let's put them on a better team, and then probably you get more productivity out of that person. I think that's exciting. It's a lot of risk. Okay, it's going to be a really messy road. Yep. But that to me is interesting.
Morgan Stanley's chief US equity strategist Mike Wilson, we are really bracing for it could be outsized reaction when it comes to the start of trading in Greater China. This is what the futures pictures looks like, both for S&P futures, but TAIEX futures already down by 1.4%, firmly at risk off as President-elect Trump vows tariffs on China, Mexico and Canada.